Clearly the markets are becoming more global, in particular around derivatives. So the CME, Leibowitz, you just saw an alliance of the emerging markets in derivatives that was announced the other day. You've got Hong Kong. There is competition in derivatives all around the world. The ICE Econ, it is not like there's not competition, and it really is a global market. That is one of the challenges for regulators, because they have to be careful that when they implement regulations in one particular area, if it's not done globally, capital can move relatively easily in derivatives in particular.
Okay. Do you guys have a name for the merged entity yet?
We get asked that a lot. My number one rule of thumb is that I know nothing about marketing, and that I should not be called into those meetings because I don't actually have a lot of patience for it and I add no value. So you will find out probably somewhere around the time that I find out. Probably better for all of us.
What are your biggest growth areas geographically and in operations? Is derivatives a big one?
Clearly, derivatives, execution and clearing are growth businesses if you look at what's happened over the last 5 years. Options obviously has been, both in the US and in Europe, has been a double-digit growth area for the last 5 years at least. And then a lot of this is around preparing for the next eventual stage, which will be as Asia emerges and grows and wants partners that are strong and have strong technology and strong distribution and strong product mixes, that this positions for that. The other strong area for us has been technology services, where as an exchange operator that operates so many important exchanges around the world, that we are in position to provide a lot of the essential pipes and plumbing and sophisticated technology to a lot of our clients who are under cost pressure, that are trying to figure out how they can compete and keep up with technology demands. So growth comes from whether it's derivatives, clearing, geographic expansion, and technology service expansion.
Okay, so in the realm of technology, high-frequency trading, good, bad, in the middle, what's your take on what effect it's having?
Yes. I think there's been so much noise around this, most of which is ill-informed. What we've said is in general, this is the natural evolution of a market where people are using technology more and more. In the old days where market makers traded by answering the phones, because remember, that's what used to happen in markets like NASDAQ, or traded by walking up to the guy on the trading floor, in the case of New York Stock Exchange or even LSE, has given way to mostly computer-to-computer trading. Now, part of the problem is there's a lack of transparency around that, both the rules and action and facts. So, for example, people say, well, 70% of the market is high-frequency trading. That's a sign that there's a problem. Well, wait a second. 50% of the market is probably market making, which has always been the case. Anyone who trades electronically essentially is being counted as a high-frequency trader these days. So, for example, 70% of the market is high-frequency. If you believe that number, we don't even know where it really comes from. The Journal today reported 32%, I believe, is program trading. We know 15% is retail. So far we've got 140% of the market. Right? And I think what it illustrates is we don't have good transparency and labeling around what people are doing. We don't have the confidence that it's being surveilled properly. So, for example, in the 87 crash, and I know you're too young to remember that, everybody said program trading is evil. And what they did to address that was they implemented program trade reporting, where everyone had to tag their program trades that said, is this portfolio insurance, is this index arb, is it asset allocation, what is it? Then as they dissected it, the evil became known, and that people realized that for the most part, program trading is a natural part of money managers allocating assets, etc. We have the same problem today. When big mutual funds trade, they are trading using high-frequency algorithms. Right? They go buy 10 million shares, 100 shares at a time. And that's because of the fragmented market structure that we have. It's because they use electronic trading because it provides more anonymity to them and lowers their cost of trading, right? Lower commissions, etc. And so I think what we have is just a lot of disinformation and non-information. And we, the industry, need to do a better job in conjunction with the regulators in providing that. I think that's why the SEC proposal to create a centralized audit trail, for example, in the US, is absolutely critical so that we can confidently say someone is surveilling across all markets. Now, there's a big debate about how that should be done. we would say as cheaply and quickly as possible, because in our minds, the longer this big question mark about high frequency sits out there, the more people question the integrity of the market. And what's really critical is that people feel that this is not a casino, this is not a rigged game, this is not a situation where the little guy is not getting a good deal. And the faster we can either get up and say, we've really looked at this, and we feel like there are no problems, or we've looked at this, and the following guys are bad guys, and we're going to hang them publicly. Or we've looked at this, and while we have found some problems where some regulatory changes should occur and that would fix it, the sooner we can get to a point where people will feel more confident in what's going on. But there's a natural distrust of technology. That's just kind of how things work. There's a natural tendency to distrust everybody else because we know that we're doing good things, somebody else is not, right? So you have that natural paranoia. Right? And as we know, it's not paranoia if everybody's really out to get you.
Right.
And it's our job as an industry, and the exchanges in particular, to stand up for integrity and transparency. That people feel like they're getting a good deal, whether they are issuing companies. Because remember, they're the ones who are often not heard from in this whole debate. Is issuers have no idea where their stocks are trading, because we have 50 destinations in the United States. They have no idea how to understand what's going on. They don't know why their stocks are more volatile, and we can talk about that later. But it's issuers, it's small investors, big investors, professional firms. It's balancing all of those to the public good. And that's our jobs as an industry, to show leadership in doing